when do we start kind of all the process for 1031?
So the first thing I would do if you called me, you just said, hey, I want to sell 2 quadplexes. I want to go into a 16-unit building or something basic, right? So I would say, okay, so you want to sell 2. Are they under contract yet? No, I don't even have my real estate agent or who I'm going to list them with. Okay, that's fine. Are they held in separate entities? Right? That'd be the next question, because it needs to be the same taxpayer. If they're both disregarded entities, it should be fine.
Welcome everyone to the Legacy Ownership Holdings YouTube channel. So for today, our guest is a 1031 expert, Nathan Webb. So Nathan, how are you doing?
I'm doing well, Jeff. How are you?
I'm good. So yeah, if you can take the stage and walk us through what is a 1031 exchange all about?
Well, I have a great presentation for you today. It's one that I use often for just teaching and training of real estate professionals, and use it even investors as well. So I'll just run your people through that today and let them, just trying to drink in the knowledge, and then we'll go through some scenarios, because I think that's often the most helpful for people. So let's share my screen. There we are. So American Accommodators 1031 exchange. This is me, Nathan Webb. I'm an exchange accommodator. I'm an investor, realtor. I'm licensed in both California and Georgia. I do a lot of commercial acquisitions for private REIT, and I've done a lot of kind of funky dispositions into DSTs and TICs. So do kind of specialize in certain structures for exchanges, not just basic ones. So I'm always happy to help answer those questions. And we are a member of the Federation of Exchange Accommodators, and have quite a bit of experience as a team. As an individual, obviously, haven't been doing these for 20 years myself, but have teams of attorneys and certified exchange specialists who have, and I draw on them all the time. First disclaimer is this: we're talking a lot about taxes, and there's a lot of legal components here, and this is just for educational purposes only. This is not investment advice. This is not tax advice. I'm not your attorney. So I just wanted to make sure that everyone's aware of that before we kind of jump in, all right? So what is a 1031 exchange? And if you want to go to the tax code, this is what you'll see. You will see a lot of legalese on how to do a 1031 exchange, what's exempt, how it works. But that's what I'm here to explain, right? So we're just going to bypass that, and I'm going to try to break it down as simple as possible. It is a section of the tax code, and it allows for deferment of certain real estate taxes that have to do with the sale of an investment real estate property, right? So there are rules, obviously, that hinge on that, and most of them have to do with time, and also the taxpayer. So let's start with what taxes are actually deferred when you do a 1031 exchange. Federal, obviously, is the one that most people know about. So that is typically, a certain rate. You also have state capital gains to consider, and that's going to vary by state. The biggest one that most people overlook is depreciation recapture. If you've depreciated a property over a certain amount of years, you're going to owe some of that depreciation back. And then also, if we're getting into higher dollar amounts, they're going to tack on a Medicare tax as well. But the 1031 exchange defers all of those. This is just kind of like some back of the napkin math that I try to run down some of these taxes for people so that they can do the calculation themselves. But always talk to a CPA or a tax professional to find out what you're actually probably going to end up owing. But federal capital gains is going to run anywhere from 0 to 20%, and they're talking about increasing that even higher currently. But most people are going to be paying 15%. It's based on your income. It's based on a couple different factors. And so make sure that, you're doing your taxes correctly, but you're probably going to be paying 15% in capital gains on the federal level. State is going to depend where you've been reporting taxes, where that property is located. And obviously there's states like Florida where you're going to have 0 capital gains tax for the state. In places like Florida where you're going to have, or sorry, not Florida, but California, where you're going to have 13.3, and they're talking about increasing that too. So it can really get up there, and you're going to add that to federal capital gains. Georgia, where I'm located, it's 5.75%. So there's also a lot of states out there that they're just going to tack on another 5%. And then depreciation recapture is 25% of whatever you've depreciated. And this does include cost segregation studies for those of you that are kind of into that. If you've done rapid depreciation, you're still going to have to pay a recapture. So you're going to be looking to do a 1031 to defer that. And Medicare's 1%, doesn't always apply, but sometimes it comes in there and it just adds another point to it. But I tell people it's pretty safe to assume you're going to be probably paying around 25% of your appreciated value when you sell. Rough estimate, I'm not your tax advisor, but it's pretty common. People are paying a lot higher, and they're really kind of forced to do a 1031 exchange. So it's pretty important. And because this has to do with taxes, you also can't file your income taxes for the year while you're in an exchange. So that's just another caveat, because maybe you succeed in your 1031, maybe you fail, but you can't be filing it as if you succeeded or failed in the middle of an exchange. So complete the exchange and then you can file your taxes. Just file for an extension if you need one. But that's one that some people miss. And as we're coming up to the end of the year, it gets more and more important. But who is the taxpayer, right? And your properties are always, they have title, right? And who is on title? Is it a trust? Is it joint tenants? Is it an individual? Is it an LLC? That's going to have a taxpayer ID associated with it. And that is the taxpayer that's actually performing the exchange. We get a couple interesting exceptions, but for the most part, the same taxpayer who sold the relinquished property must purchase the replacement property. It's not that the taxpayer changes, it's just that there's some structures that we can do to ensure that it's the same taxpayer, but provide some protections or some exchangeability. But it has to be the same taxpayer at the underlying tax level, okay? So you can't change things around like, hey, I'm gonna sell a property by myself and then form a partnership with somebody and put my funds into that partnership as an LLC. That's a new taxpayer. Your tax as partners now. You can't do that. So you have to do things a different way. The big thing as we're kind of wrapping up talking about taxes, I know we talk about a lot of it, but remember, this is deferment, meaning that if you didn't perform a 1031 exchange, you would owe back taxes as well. It's not a forgiveness of them, but there are ways, and people do this all the time. They continue to do 1031 exchanges, and then they put them into like a living trust, or they pass it on to their heirs, and when those heirs receive that property through the trust, then they get a step up in basis, meaning they don't owe all those back taxes. So swap till you drop. But always, of course, consult an attorney when dealing with those living trusts, and always consult your tax advisor when looking into those things. All right, so hopefully we're kind of just over those taxes, and we're just going to get into what is actually exchangeable and more into the meat of the 1031 exchange. Real basic, it needs to be real property, and it needs to be intended for investment or productive use. There's a lot of gray areas in the tax code, but basically, as long as it's not your primary residence, you can exchange it. And even if you've had it as a primary residence, but you moved primary residences and you just rented it out for a few years, it's still in your name, but hasn't been a primary residence, then it qualifies for a 1031 exchange, as long as it's had a couple years being an income or investment property. And as long as it's real property, you can go into and out of it. So people call these a like-kind exchange. And the reason for that is you used to be able to exchange businesses for business or real estate for real estate. We only have real estate now. We don't have the business line anymore. So as long as it's real property, you're buying real property. And that means single family homes, condos, apartment complexes, industrial, raw land, even oil and gas mineral rights or easements that you can put a cell tower or a billboard on. A lot of those, they're all exchangeable. Okay. Why would you do one? And you know, there's a lot of reasons. One that I think is particularly powerful is just the growth and preservation potential of it. But you know, there's a lot of other reasons that a 1031 exchange can help you consolidate, for example, a lot of properties into a single larger property. Maybe you want to do it the opposite. Maybe you want to sell a big property and go into some smaller ones. A lot of times I'm seeing people trade highly appreciated but low cash flow assets like California, where you know you've seen $200,000 in appreciation, but it isn't paying you anything, and you want to go into something that's going to give you a return on that in another state. That's a big part of 1031 business. And then you know maybe you need to trade for a higher basis property to take advantage of depreciation, or trade a fully depreciated asset for a new one. So that's another strategy that people are using. Sometimes they just want property closer to where they moved, or like I said, maximize their equity that's in a property. They can't refi it or don't want to, but they want to take the equity that's in a property and stretch it to the max by buying a bigger and better property. You get to keep 100% of your equity that way. And that's the really powerful tool of the 1031 exchange, okay? Excuse me. So a quick example here, very basic property. I mean, these are very broad generalizations, simple napkin math, okay? Don't take my 100% value on it. It's very broad and basic, but let's say you put $25,000 into a $100,000 house. You know, you're going to be paying about 25% on your taxes for this house because you sold it for $150,000 years later. So you made $50,000 in appreciation that will be taxed to some percentage degree. But your commissions and closing costs aren't part of that. So we're going to take $40,000 in capital gains. And so my original equity, and of course you'd probably have more because you got some principal pay down, but let's just say you're taking out your cash equity is $65,000. So you can take that check at the closing table and pay your taxes and then have $55,000 to reinvest, right? Or you can do a 1031 exchange and have 100% of that to reinvest, okay? So, oh, well, that doesn't seem like much, 55 versus $65,000, but for a smaller property as we bought, that's significant. And then leverage that out. So what, you know, if you leverage out $55,000, you're kind of capping out, you know, let's say 75% loan to value, you're capping out $220,000 versus 65, you're capping out more at $260,000. So that gave you, not only did you save $10,000 on taxes, but it increased your purchasing power by $40,000 on, look at this, on basically $40,000 on capital, on your total capital gains. You kind of doubled everything there. Isn't that interesting that that's kind of how it worked out? And I mean, that's my percentages and numbers, but you can really start making some big gains here if you do this right. And this is just if you compound it over time. You know, don't read too much into the numbers. This is just kind of assuming some basic things. But let's say you did 5 1031 exchanges and you saw the same amount of appreciation each time and you're paying about the same percentage in taxes, which would not be the case. But if you did, you would have double of what you in equity and then potentially cash flow, right? You would have double that if you perform the 1031 exchange versus not performing the 1031 exchange, right? And so here's the kind of graph I need and like. This speaks volumes to me rather than all those numbers, but basically it's exponential growth, right? You're gonna have, after years of doing 1031 exchanges, oh, you've got this heavy tax burden, but look at the equity you have, kind of cash flow you're getting versus if you paid those taxes every time, right? So this is the kind of growth potential we're talking about. Not the only reason to do a 1031, but probably the most common one, right? So you know you need or want to do a 1031 exchange, but what do you need to do before you do that? Most people find out from their CPA that, hey, you should probably do a 1031 exchange on your property here, because otherwise you're going to be paying a lot in taxes, and that doesn't make financial sense for you. And so consult with them, and then consult with your exchange accommodator. Say, hey, I need to do an exchange. I don't know what I'm doing, or I want to do this property into this property, and this is how I want to do it. Is that all okay? And make sure you're doing this before you close on your property. Don't bring your 1031 exchange accommodator into the conversation at the closing table. Give them a couple weeks heads up. Talk to them before you even list the place. Just make sure you're thinking about this property. Preparation is always the key to success. But they do have to sign property specific tax deferred exchange agreement and a relinquished property contract before closing. And then your escrow will have to work with the accommodator, work with the QI in that case. So that brings us to the next slide. So basic forward exchange, bread and butter of what I do a lot of times. 99% of the exchanges being done out there are forward exchanges, and this is how it goes. You put your property up for sale, it gets under contract, someone wants to buy it, gets past inspection, they're serious about closing. You need to talk to your exchange accommodator. I need to do a 1031. Great. I'm going to pull some documents from your closing agent or escrow or title, whoever you're using. I'm going to draft your documents, send them over to you. You're going to sign them, right? What that means is that now your closing agent is going to send the money from closing. They're not going to write you a check or wire it to your bank account, because that wouldn't be a 1031 exchange. They're going to wire it to ours. And we are a glorified money holder. We hold your money. We start your timeline and your clock. We're handling your paperwork. You are looking for property, or maybe you've already found property, but you're doing the searching. And then when you find a place, you get it under contract. You can use the money that we're holding as a proof of funds if you need to. But you found the property, you get it under contract, then you talk to me and you say, hey, I need to put earnest money on this property, or hey, I need to put it down a deposit, or send all of my money to close on this property on this date. You communicate with the qualified intermediary to do that, and they do all the proper paperwork. They wire the money, you close it out, and they close out your exchange, and they send you that packet. Hey, you've done a successful exchange. Here's the background for that. Make sure and put this with your tax documents so that the IRS knows you performed a successful 1031 exchange. And then you can file your taxes if you were trying to do that, right? That's a basic 1031 exchange. Let's get into the details a little bit more. And I like to treat this like a game because it is. There's some kind of funny rules to it regarding timelines. But if you look at it as if, hey, I was going to pay my taxes anyway selling this property, but I get to roll the dice, or I get to take a chance on performing a 1031 exchange and defer 100% of my taxes. That's the proper way to look at it, because then it's fun and not a big bothersome worry. Now, if you owe a lot in taxes, you really need to succeed. Let's talk about strategies to do that. But first rule that everybody typically hears about is the 45 and 180 day timelines. Those start on the day that you close the property. So the closing date, the date they record title when you sell, that's day 0. Next day is day 1, right? On day 45, you must identify or designate replacement properties. If you have a property under contract, there's nothing, we can wire funds to that and do the whole 1031 process. But by day 45, whether you're under contract or not, you need to say, hey, I'm doing something about my 1031 exchange. I need to extend out to day 180 in order to close on these properties, or one of them. If you don't identify, then on day 46, your exchange is considered failed. I can send your money to you, you're going to owe taxes on it and that sort of thing. But you can kind of proceed as usual. Whereas if you say I'm going to extend and go all the way to day 180, then I have to hold your money and I have to put it into the properties that you told me you were going to put them into. I can't change all that and throw it over here, willy-nilly. So you're the one telling me what to do with your money. And then the other rule is leave no boot. If you want 100% tax deferment, you can obviously take boot, but you're going to be taxed on it to some degree. I always recommend not doing it. Obviously, it's just a cleaner exchange that way. If you're in California, there's special forms you have to fill out for boot, and it's not fun. So leave no boot means 100% tax deferment. And kind of how we do that is, when you identify, you get 3 properties that you can identify, no consequences, no additional rules. You can close, you can say, I'm going to identify these properties and close on one of them, or you can identify 3 properties and close on 2 of them, and they can be 1 and 2, 2 and 3, or 3 and 1, or however you want to do that. So that's an opportunity to get a little creative. And then boot is use 100% of your money and then purchase a property or properties that were greater than or equal to the value you sold for. So that little house for $150,000 that we sold, as long as I am buying a property that's $150,000 or more in value, I'm golden, right? We can really drill down onto exactly what you need to buy in terms of purchase price and stuff, but that's the simple, basic way to do it and do simple math like I like to do, okay? Pretty simple rules, right? We can get complicated. We can get into maybe not advanced rules, but more advanced strategies for designating backup properties. If you're only going to close on one of them, but you need to do a 1031, hey, I can't even take this boot, or I found the property, I closed on it, but now I've still got, a couple $100,000 in my exchange account that I don't need, and I need a place to put it. Should I take it out as boot? Maybe. Should you not? Do you need to put it somewhere? Identifying percentage of property or using partnerships, tenants in common, Delaware statutory trusts, when to get out your money, do it through a refi. That's a big strategy is don't try to take it out as boot, close on the property, finish your exchange, refinance the property, pull the equity out that way if you need to do that. If you're going to identify more than 3 properties, we need to talk because there's new rules involved. Most people don't go here. It's not as common, but if you do, hey, that's fine. You just need to be aware of the rules, and maybe that strategy makes sense for you. For most people I have found, they think about it too much and it gets too complicated. And because they're not focused on getting the exchange done, they fail. So if also they focus a lot on reverse exchanges or improvement exchanges, this requires a lot of legal work. It's more expensive. You may think, hey, doing a reverse sounds way easier. It's not, okay? You need to be well prepared for it. I could explain that to you, but you would need to speak with your CPA. You would need to have an exchange attorney that provide all that legal title holding entities and that sort of thing. Attorney's going to charge you money for that. And then you still have to come up with the funds because until you sell your property, you don't have funds. So you need to have funds on the sidelines or a way to work that out to purchase the property before selling yours and returning those funds. So that gets complicated, right? But to kind of cover that in a little more detail, forward exchanges, that's the one we explained. You sell a property first. Funds go to a QI, you have 45 days to identify, 180 days to close, put that money into a replacement property. That's the order. The reverse is, hey, I found the property. I need to close on it before I've closed my relinquished property. So I need to get an attorney involved. They need to create a title holding entity. And I need to purchase this some other way, with that title holding entity, and then I would have 180 days to sell my relinquished property or properties and put them into this new property that I bought, trade all the funds out. trade out the title holder and do that sort of thing. So is very possible, just gets more complicated. There's a build to suite or build to or construction improvement exchange, a lot of names for it, but it allows you to use your funds to improve a property. But again, that gets complicated too, because we're kind of acting like the bank and approving, that funds be dispersed for these improvements and approving the value so that the total replacement value still meets or exceeds your relinquished value. Gets complicated, but it's there, just so you know about it. Here's some tips and tricks. These are for your listing agent, your realtor. These are for investors. These are just kind of what I have found, help get things done a little bit more smoothly. A lot of people put in their terms of the contract it says buyer acknowledges that seller intends to perform a tax deferred exchange pursuant to section 1031 of the Internal Revenue Code. Buyer agrees to cooperate in such exchange at no additional expense to buyer. So if you're selling, you're basically telling the buyer, hey, I'm going to do a 1031 and I want you to cooperate. It's not going to cost you anything, but I want you to cooperate. If they agree to that, might give you a little leverage to say, hey, I'm going to delay closing now. I need a week, I need a month to find my replacement property because I really can't blow this exchange. And if you're working with other investors, they may understand that and be like, oh, that's fine. We'll do that. So it doesn't always work, and it's not required. You don't have to put this in the contract for you to do a 1031 exchange, and it may not get you anywhere. But it is helpful for some people, and I have seen it used to success for that. So just know that it's there and it's possible, and it might be a strategy you want to employ. Delaware statutory trusts are always available. There's always something out there that you can put money into in a percentage. There's also other tenants in common, other kind of open fund options that you can place funds into. But if you need a guaranteed kind of closing, make sure to have these options available. Maybe you really want to get that one property you have in mind, but it's more important that you get a property than the property. Always put in a backup option when you identify. And then when it comes to actually purchasing the replacements, nothing is preventing you. You've done your exchange, I'm holding your money, you're looking at properties. You don't need my permission to write an offer and get under contract. You don't need my permission to do the inspection. The only thing that you need me to do is send money, right? And I can send earnest money, I can send your deposit for the replacement property, but nothing prevents you from putting money into, for getting a contract, getting under contract, doing your inspection, deciding if you want the property or not, before you identify. It doesn't matter. You could be under contract on 3 properties and fall out. Excuse me, fall out of 2 of them, and that's perfectly fine. There's nothing wrong with that. So be aggressive on making offers and getting the replacement. I highly recommend it. So real quick, we're going to kind of break into purchasing percentages via tenants in common. This is similar. This is old school. So tenants in common is a title structure as old as time. There's not a whole lot of rules surrounding it, but it does allow you to purchase a percentage of real property and go on title, right? So this is what we talk about when there's a same taxpayer who needs to purchase a larger property, but maybe they need to be partners with somebody. You can't go into the same LLC, but if you're Susie Q exchanger going into a property with me, and I'm the partner, then I need to be on title and you need to be on title. Actually, you need to be on title for sure if you're doing the 1031, but I can be on title and we can split the property 50-50, 60-40, 20-80 through tenants in common. And then for people who are familiar with syndications or joint ventures, you can actually do that with with tenants in common in conjunction, right? And so this gets confusing, right? But it is totally possible. And trying to do it as a bar graph or a pie graph is hopefully the best way that I can explain it, right? But you have a property here which represents the whole pie. Okay, there is a syndication LLC, and within the LLC you have the active partners, you have the passive partners, you have different shares. That they're going to make up the majority of the pie, but they're broken up within the same LLC. So this is actually the same LLC, and they're just kind of within each other, right? But you need to come in and actually purchase a piece of the pie to satisfy your 1031 exchange requirement. You can't go into the syndication, right, with your 1031 funds. You need to purchase a piece of real property, and you need to be the same taxpayer. So if Bob, a single unmarried man, sold his property, he would need to go into this property as Bob, a single unmarried man, at whatever percentage satisfies his 1031 exchange requirement. But that's how he purchases the piece of the pie. Same thing if you had, maybe you had a partnership that was ABC LLC and it's you and another partner. You sold, a duplex you guys had, you wanted to go into an apartment building with a syndication, you would need to purchase, a piece of the pie, a percentage of undivided interest as tenants in common in that real property as the same taxpayer that you relinquish property in. Okay, people can put money in and out of the syndication LLC because it's considered personal property, not real property. You have to purchase real property. You have to be on title. Tenants in common is the way to do that to satisfy your 1031. Okay. This is similar to what a Delaware statutory trust does. Different structure. It is a security. It is different, but it's kind of roughly based on tenants in common or a TIC. Okay. So let's just go through some examples here of kind of exchanges that I've done that, just let you know what the possibilities are, because there's a lot of possibilities. Okay. Bob, not his real name, was retiring from farming, and he had his farm and his land as Bob Industries LLC, right? So when he sold it, he got a pretty good penny for it, but he did have some debt on it. But he got $4 million, and he had a debt requirement to satisfy, but he also wanted to buy kind of a retirement home. But he buys a single family residence for $500,000. He buys some triple net properties, such as a medical building. He gets a cap rate on it, so he's getting cash flow. He takes out a loan at a certain percentage, which covers the equity and debt requirement that he had. And then he's put some money into some oil and gas royalties, gets a good return there. So he's getting this annual passive income. He's getting great returns. And he owns this home free and clear. And then he decides he's going to make it a primary residence after holding it for investment or income purposes for a couple of years. And then he can even change title into his own personal name out of Bob Industries. But he purchased all these as Bob Industries from being a farmer because he sold his land. And, then he was able to go into some different passive income investments and make a good return and retire well, all through a 1031 exchange. And, he bought that farm for dirt cheap. He had a lot of taxes he was going to owe. He had fully depreciated it. So he saved a ton of money by performing a 1031 exchange. Sue, who's relocating from California, sold one duplex in California and bought 4 single family residences in Oklahoma. I mean, the cost difference is completely different. They wanted to do it all cash, so they sold a duplex for $600,000. They bought 4 single family residences for $150,000 each, all cash. And then they had a lot of options, but they could refinance them, pull the equity out, at 20% down, still make cash flow, have $380,000 in cash to buy a car, purchase, more property, do whatever you wanted to. Or just, you didn't even have to refi. They could have just held it for cash flow, turned one of them to a primary residence. But the big one here is they deferred over $100,000 in capital gains, and relocated themselves, chilled out in life, grew their portfolio, owned property closer to family, a lot of good benefits through a 1031 exchange. This is the one that gets pretty complicated, but it shows the power of what you can do through 1031, through a reverse exchange, through a forward exchange. Maybe I forgot to mention, but you can actually sell 3 properties, or you can sell however many you want, but you can sell more than one property and put it into one exchange. Okay. And as long as it's sold, they're sold within the 45-day timeline that starts with the first property. So you sell one property, you get 45 days to identify, but you also get 45 days to put any more properties you want to into that exchange, right? So that it's kind of a double timeline. Most people don't know that, but you could also do 5 separate exchanges. It doesn't really matter, but there's a lot of possibilities is what I'm trying to say. So this particular person, they had 10 single family residences in multiple states, multiple locations, obviously pretty hard, but they were like, I'm done trying to manage all these little houses all over. I want to get into my own apartment complex. I want to save money. How can I do this through a 1031? Yes. They weren't able to sell all of their properties in one go, but they were able to sell 5. They consolidated all of those into one forward exchange. And they wanted to purchase this apartment building. They got under contract. But they needed to do a reverse on some of their other properties. So they were able to purchase this property. They placed an exchange accommodating title holder on part of the property so that they could then take the rest of the properties they had in other states, get 180 days to sell those, and put them into put that equity into this property, and then replace the title. They own the apartment complex. They were able to defer their taxes. They utilized a couple different exchange options, but it totally worked out, and they were able to save a lot of money and consolidate all of their properties. These are possible. Was it easy? No. Was it a little more expensive than just doing a forward exchange if you could sell all 10 in one go? Yeah, it would have been easier to do that, but this is how it worked out. And then this is a pretty common one. Got a lot of people who, they want to get into more of like a passive role. They've been actively managing a smaller asset. They want to get into a larger building. So Jen sold her triplex for $850,000, and she had $500,000 in equity and $350,000 in debt. She partnered with a syndicator, so that she was bringing 25% of a $2 million raise for a syndicated deal. And she was able to identify a percentage of undivided interest in the whole property, in that deal. And so she accounts for like 17.5% of, the real estate, and the syndicator accounted for 82.5% of the real estate. And Jen signs on the loan. She has to do that for tenants in common. You don't have to do that for a Delaware statutory trust. And the syndicator runs the operations. They take care of the whole deal. There's a management agreement between the TIC partners that the syndicator is going to run everything. And actually, they did a refi after a year. It all worked out where they were able to get the property better and get financing. And Jen was actually able to get 100% of the money she put in back, tax deferred, tax free, through refinancing, because she still had equity in the deal. And she put that money into another deal, and kept growing her money. and the syndicator later sold for like $8 million years later. So there was more appreciation. And Jen still held a piece of real property. So she was actually able to do another 1031 exchange, and again, and do another building. So she really saw some growth just by, partnering, selling her duplex, utilizing a 1031 exchange, a tenant in common agreement. Great possibilities there. It doesn't have to be an apartment building. It doesn't have to be a triplex, as long as it's real property. There's a lot of possibilities, and just hopefully sharing these stories will hopefully get your mind jogging a little bit for what some of the possibilities are. And then this is my contact info. Basically, I put this out there, like I'm not trying to run you through a website or through Facebook or anything like that. Like if you want to do a 1031 and you need a consultation, call me. That's what I'm here for. I'm here to help. I'm here to see if I can take a couple minutes, and if your 1031 is possible, or you need to do something, get on the phone with me and we can figure everything out, because I have to be in contact with your closing agent anyway to do anything. So and then when you run into bumps, and you're always going to have bumps, you're going to need to call me. So why not just start with a phone call? So that's my contact information for you guys. And that's it. I went pretty quick, So if you need to review anything, go back and listen again, and hopefully you can understand me. But that's the gist of it. That's my run through.
That example that you gave is really, really helpful. Then
which one?
Yeah, those the ones for the syndication. So let's say Jen, and this because this is mostly common, like since people most likely owning like a quadplex, triplex, so they are in the hundreds. So now they want to be leveled up to the $1 million kind of properties. So, and then I think as you mentioned, is tenants in common is the really route to go whenever like dealing now with commercial in the commercial space.
Well, I mean, a lot of people do a Delaware statutory trust, but that is different in that while it still allows you to purchase percentages of real property, it's a security. You need to be accredited. It's very specific assets. They have to have very specific business plans. The tenants in common have some requirements from the IRS, but it's a bit more of the Wild West because it's been around for so long. Tenants in common have been around for so long, and just because Delaware statutory trusts have kind of come up, in terms of popularity, I guess. Excuse me, but I mean, people are still doing 1030 ticks and tenants in common all the time. It's about finding those partners and finding who's willing to work with you, because a lot of syndicators, like for this example, they're not going to work with you for $100,000. You need to, because it's a lot of paperwork. It's a lot of paperwork. There's, more expenses involved. So if you're bringing what they would typically raise in just a share of the syndication, it's usually not worth the headache to take that as tenants in common. You're also splitting hairs. You're getting really small percentages and really, really big deals. And there's some identification issues that come up with that too.
Yeah. By the way, so what's the common that you saw, like in terms of DST versus TIC nowadays?
I think it has to do with what your plans are.
Okay, but majority, like is it like everyone's doing TIC, or it's kind of equal?
No, I mean, I would say most people are kind of doing their own 1031. They're just going from this property to this property.
Oh,
I get a couple like weird joint venture deals that I handle. I've gotten several syndicated deals, gotten several DSTs where it's just people are they just need cash flow. They want no headache. They don't know about tenants in common. They don't know a syndicator. They're just, hey, I just want something that's a little more stable or guaranteed. They don't want the big value add play, because they need steady cash flow, not low cash flow and then another 1031 because they're not in grow mode. So there's everybody's going to have different needs. And, I try to help solve some of those problems where I can, at least say like, hey, well, you could do this. Ultimately you need to make that choice, or you need to have those relationships. But I do what I can. I couldn't tell. Yeah, most people are just doing a sell this small apartment building, and our whole joint venture is going into the next one. Excuse me. Or they're just selling this vacation home that they were Airbnb-ing, and they're going into another one, somewhere else, because they kind of want to do the same thing. It's
Yep. So by the way, like, so this, if it's a joint venture with, let's say let's say Jen sold this one, then she found another partner. So only two of them. Then for the JV, is it enough just for Jen to be on the title and that other person to be on the title, or there's no tick involved? Is that enough, or
no, it would still need to be tenants in common. But
still,
let's say it's me and you, right? Like I'm doing a 1031. We both want to go into a project together. The requirement is I'm on title, and so you purchase 50% of the property. I purchase 50% of the property. I have my own LLC that's just me. You form an LLC that's just you, and those LLCs own 50% each of the property. Now we could potentially, melt those together after a couple years. After a period of time, we can change title a little bit. So if we wanted to truly partner on the LLC level, there's possibilities there. But maybe we're ready to sell in a couple years and go our separate ways. The property's appreciated. We now both have the option to go our separate ways because we stayed in that tenants in common. I have people who, they did a joint venture together. They were all in the same LLC, but one person wanted to, or two people wanted to do a 1031 exchange and go somewhere else, but the other person's like, no, I want my money. I want to take it out. They could actually drop out of the LLC, take their money, and you drop it into a tick right before you sell, and then they're able to go their separate ways. Doesn't always work out. It gets, like I said, we're getting into the weeds a little bit, getting a little more nuanced, but there's possibilities.
Okay. Yeah.
For joint ventures as well that are smaller. Don't need to be syndicated deals, don't need to be DSTs. A lot of possibilities.
Okay. Yeah, then maybe let's walk through like kind of an end-to-end scenario in terms of, let's say I have quadplex, or at least I'm on the residential side. So duplex, triplex, quadplex. Then I want to jump into the commercial space.
Yeah.
Then the moment like I decided, okay, I'm going all in, selling all the properties. So assuming, let's say maybe you have two quadplex to be quick. Then, so what's let's say I decided to sell quadplex. Then I contact you, right? I called you up. Then that I'm interested selling my quadplex. Then I'm basically like will look for commercial. Then what kind of do you need any documents or from me at the time, like when I just decided, or when do we start kind of all the process for 1031?
So the first thing I would do if you called me, you just said, hey, I want to sell two quadplexes. I want to go into a 16-unit building or something basic, right? So I would say, okay, so you want to sell two. Are they under contract yet? No, I don't even have my real estate agent or who I'm going to list them with. Okay, that's fine. Are they held in separate entities? Right? That'd be the next question, because it needs to be the same taxpayer. If they're both disregarded entities, it should be fine. But if one's a partnership and one's just you, going to be a problem. Okay. But let's just say, for the sake of ease, they're both in one LLC that's you. Great. And you were going to be able to take that LLC and put it into the 16-unit building. So I would say, let's try to put both of these into one exchange, because it'll just be easier. But you have to sell those within 45 days of each other. So get them both ready, get them both on the market at the same time. Hey, let's, and then maybe talk to your realtor and say, and let's make sure that they're going to cooperate with my exchange, because maybe put that terminology in there so that I can delay closing a little bit on one if one of them's having more trouble than the other, just so I can make sure and try and sell them pretty close to the same time, because the closing date is what matters on that. And then I would say, do you already have that 16 unit under contract? And they would say yes or no, or hey, we're talking, but they're willing to actually, or we are under contract, but they're willing to wait until I sell my two quadplexes. This is great because you can hold that under contract. You don't have to do a reverse exchange. You can hold it under contract and sell those other two properties while they're holding it. And so that's what you work out. So I would say, okay, great. I don't need the paperwork on the 16 unit yet. But when you get the quadplex under contract, you need to just send me an email and connect me with your closing agent, whether that's escrow, title, whoever's doing your closing. I'm going to ask them, I'm going to say, hey, I'm going to handle Jeff's 1031 exchange. I need these documents. They're going to send them to me. I'm going to draft your documents for your exchange, for your properties, and send those to you to sign, right? You're going to read through them, understand what it is. And then those signed documents go to the closing agent, so they know, okay, Nathan's going to be handling this exchange. So when Jefferson's first quadplex closes, that money goes to Nathan, his timer starts. And then when the second quadplex closes, that money goes to Nathan, and I'm holding it. And then we go to your 16 unit and say, hey, give us the paperwork on this. Everything's ready to close. And we wire the money over there. You have to do another assignment contract to assign those proceeds to that property, and make sure it's the same taxpayer, all of those things. So I'm mostly doing the juggling. You're signing a couple papers, and I make sure everything's good to go, wire the money over, they close it. It's a very typical transaction that way.
So then let's say the quadplex need to close, so you have the fund transferred. So they need to time it in such a way they should not be putting, I guess, the 16 units until it's fully the quadplex are fully closed, so that they can use the money proceeds for the EMD or whatever they need for the 16 units.
Right. So let's say you didn't have it under contract. Let's say you were looking for it. Okay. So you sold both your quadplexes. You signed the documents, the 1031 documents. I'm holding your money. You're looking for this 16 unit. Let's say you find it on day 43. Great, right? Your deadline's close. You found it on day 43. You're going to need the additional time to close, but you say, Nathan, I need earnest money. So talk to me day one, got this under contract. So Nathan, need earnest money. Okay, I'm going to have to know where to wire that money to. And I'm going to need the purchase contract to make sure it's a legitimate transaction. I can wire earnest money. So then you can start and do your due diligence. You can do everything you need to do. And then day 45 rolls around. On day 45, we're going to say like, hey, should we identify this property? Yes. You have no intent to buy anything else. So we just put that 16 unit property, which is just the address, maybe the name of the property, but we definitely need the address, or we could do the parcel number, or some other identifier of that property. That's what you identify. You submit that paperwork that goes into your exchange packet that we're building for your exchange for tax purposes. So you did identify that property. And then, you have the remaining 180 days to do your due diligence, get financing if you need some additional financing. If the lender's like, well, you're doing a 1031, I need proof of funds. Nathan, can you send my lender proof of funds? Yes, I can do that. I send them to them. And then, day 60, you've already identified, you've still got plenty of time, 120 days, but you say like, hey, this is the property I want, wire the rest of the deposit and let's close this property. That's what I'll do. You'll close the property. You'll sign the documents. I'll wire the money. You close it out, and your 1031 exchange is complete. I'll mail you your packet that you've successfully completed 1031 for your tax purposes. You can send that to your CPA, and you have a new property, and you've done a 1031.
Okay. Then yeah, so let's say now you have these 16 units, then you filed the tax already, like for that fiscal year. Then do you need to keep those 1031 packets like for future reference? Let's say now if you try to buy, now you grow, you're selling the 16 growing to 32 or whatever.
I would
Or
always keep my tax records if I were you.
okay, so at least just for sure, like because yeah, how do you keep track kind of the tax deferred so far that you have done, or those kind of.
I mean, the IRS gets a copy too. So that's why people try to kind of do their 1031. I mean, the role of the qualified intermediary is there for a reason. You know, we're supposed to be an uninterested third party that basically holds the money and reports to the IRS, but you're our client. So you tell us what to do. We're just making sure that you're abiding by the tax code. So, you know, just realize like the IRS knows that you successfully, they get the track record of your exchange as well. And they can see, hey, you know, this entity sold this property. I can see the title right here. You know, they're going to look at tax records, or, you know, the property you sold has a new owner. So you obviously sold it. Oh, and the same taxpayer now owns a 16-unit building. You obviously bought it. You're paying taxes on it. So they can tell, you know, and they'll just look at the 1031 exchange packet for reference and make sure it was all clean. And, you know, so I mean, it's not like the IRS is going to audit you just because you did a 1031, but, you know, it's always good to have proof if you do get audited.
Correct. Yeah. And also like the tax deferred one, are those included in that 1031 packet? Like, so when you purchase this property, this is the tax deferred so far that you have done. Then keep that in mind maybe when selling this. So how
I
much?
tell people, talk to your CPA. I don't know how much taxes you owed. I don't know how much you deferred. That's a question for your CPA, because it's based on your income. It's based on the appreciation. It's based on depreciation. It's based on too many factors that I don't know, because I'm just accommodating your exchange. I'm not your CPA.
So basically like it's a question more on the CPA. So at least like
Yep.
to monitor, at
Yep.
least manage up to the end.
Get a
Basically.
good CPA. Make
Yeah.
them keep all those records.
Yeah, I guess the ultimate probably is if hopefully like you will have a CPA through the rest of your kind of like your investing career. Then yeah, or
Yep.
at least, but I think it's better still like if you can keep maybe a soft copy so that it's saved in your
Yeah. No, you'll get a hard copy. You can get a PDF. You know.
yeah, then at least it's better. So just in case you need to change CPA, or maybe the CPA that you're working on is already retired, not doing the business, then at least you have some copy for the next CPA to kind of go through all the different 1031s that you did and
Yep.
tax deferment. Okay. Yeah, I guess then maybe the last scenario that maybe we can talk about is those who wants, let's say I'm done with managing tenants. So
Yep.
I'm selling either commercial like 16 units or selling my own residential quadplex, triplex, then I just want to be passive. So in this scenario, let's say, so maybe same sample, let's say 2 quadplex. Then I want to invest it in a syndication deal. Then at that point, let's say, yeah, so it will be similar, I guess, discussion up front that, okay, I am interested in selling this quadplex, then I have it, or yeah, I have it maybe under contract, then engage you right away. Then I want to, I found like a group or a general partners who is having their deal. Then what's the document or what do I need to do basically from there on?
Again, you're just going to connect me. So same situation. You sold your 2 quads. You're going into a partnership on a large 500-unit apartment deal. I don't know. And you have your syndication partner who's agreed to, you know, put your funds into a tenants in common with the syndication.
Okay.
So we'll need to do all the typical things. I'm holding the money, but you're going to need to get a TIC agreement, tenants in common agreement for the property. You're going to need to have a management agreement to satisfy the safe harbor requirements. So there's going to be an attorney involved. I'm not going to write that up for you. The attorney's going to write that up for you, for the state, for the property, all of those things. So you're going to have those documents. And then and then you're going to need to, show me that you are purchasing, that your LLC or your name is purchasing that percentage of interest. And let's say, you're running into the timeline again. Hey, you need to identify, well, what do I need to identify? I'll say like, well, what percentage of the property are you getting? Is it 5%? Is it 15%? I don't know, but you need to put that on paper. And so you would say, I'm purchasing a 12.5% undivided interest in, 123 Main Street of Houston, Texas, or wherever it is. You're going to put the address, maybe the name of the project or the apartments. And so you would need to identify that way. So that would have to happen at some point. And then once I have all the papers from your attorney, the syndicator, you're getting title, I see that on the title commitment before closing, I see all these things, I can wire your money. You're going to sign the assignment and disbursement agreement. I send your money over there. They close it out.
Okay, so mostly it will be like a attorney in this case, right? So because I know like every syndication has PPM and all this operating agreement. So attorney will work with, I guess, the whole GP or general partnership.
They've got to have, because that GP is purchasing they're going to actually have to assign. So most of the time that the GP is buying the property, they've signed the contract. It's going to be them or their entity that's buying. So their entity is going to actually have to assign you a percentage of that property. So I'll need to see the assignment. I'll need to make sure that you're getting a percentage, but that shows up on the title commitment. So when I see that there's a clear line that you're getting what you identified, we can send funds in. Now, you need to make sure that you're getting close to what you identified. You don't want to be too far off from that. If you identified 12.5%, but you only ended up purchasing 12.2%, not exactly 12.5, you're okay. If you ended up purchasing like 5% and you identified 12.5, that's not right. So you do need to work with the GP and make sure that all of your ducks are in a row, that hey, this is what we're doing. That way you can identify correctly. That way you can close correctly. That way you can make sure you're getting on title, all of those things, tenants in common agreement. So there's more paperwork involved, but it's different too. You're not purchasing shares in an LLC, so it's not private placement, it's partnership, but it also needs to be limited partnership to a degree, because the GP has to manage your share to be a safe harbor. It gets a little more complicated, so make sure you're working with an attorney and the GP directly. You're not just like, oh, I have a deal out here I need to put money into. You need to have those relationships and establish them with the right partners that know what they're doing, so that they can put you into the right property.
Yeah. And I guess like, and also like for people who's interested in deals like this, reach out to the general partners, because they are the ones who will also be approving, or because if the exchange that you're doing is enough, because the cost will be higher in closing this having ticks in the deal. So I think most GP that I know of, it should be like a substantial kind of exchange that you're doing. Even like I know some are they will only entertain ticks if it's at least $1 million or something. Because
$500,000, $1 million, a lot of them it's $1 million at least.
Yep.
So, if you got smaller amounts, you probably need to look at joint venture deals. Doing kind of like smaller apartment buildings with just a couple partners, or there's other, maybe you need to, if you just need to be passive, you look at a Delaware Statutory Trust, or you look at just other options out there.
Oh yeah, but waiting for this DST one, like yeah, what's in terms of paperwork, is it anything different to TICS or what any, because I know like they were saying like DST is the way to go if, let's say, as you said, like at some point initially everyone was on board, then eventually maybe after 2 3 years some of the partnerships say like, oh, I want to pull out my money, then their option is kind of a DST or something, so that I don't know, like I heard it from someone.
So I would say that the most significant difference is your excuse me, it's you need to be accredited. It's a security. You need to be accredited to do a Delaware statutory trust. You
Okay.
don't have to be accredited to do a tenants in common. But if most syndicators are requiring, $1 million, you're going to be accredited, right?
Yeah.
Probably. And so, but you have to sign on the debt with tenants in common. If you have debt that needs to be replaced, you need to sign on the debt. And so that adds a layer of complexity to tenants in common. Whereas with the DST, there's a manager involved, and they have already placed the debt. You get credit for the debt, but you don't actually have to sign on it. It's non-recourse. So it's great for people who, they're looking to retire. They need to replace their debt, and they always put a similar amount of debt on the property, which is like 50%. Most of them put like 50%. Some do completely different structures that have more debt, less cash flow, or I mean, there's all kinds of stuff that they do out there. So it's just a different way of purchasing percentages of real estate, right? But it is a security, so broker dealers involved, tenants in common, it's real estate, it's a title structure, so you don't need a broker dealer. You can do a lot of different partnerships, private partnerships that way. Signing on the debt with tenants in common, don't need to do that with a DST. A Delaware statutory trust probably has it has a longer game plan usually. Usually they need to have their game plan for a few years out, whether that's doing an UPREIT or a 721 exchange, which allows you to actually purchase personal shares of a REIT. So you can take your real property and buy shares. And I know people who do that, like retiring. They'll go into a DST and then do an UPREIT so that they can give their kids shares where they're still getting cash flow, but they can give their kids shares and divide it more evenly between their kids, rather than, hey, I've got 3 properties, but they're all different, and I want to give, I can't give the kids all the properties because they're just going to fight about it, but I want to give one to one and one to the other, and they're going to be mad at me and each other. So they're just like, I'm just going to take care of the whole thing with a Delaware statutory trust, get some passive income while I'm retired, do an UPREIT, so now I have shares that I can give to my kids. So, like I said, so much of this depends on what your plan is, what you need, what you want to do. And then there's usually an option for it, and just be prepared. And sometimes, I mean, I've had people who wanted to do an exchange, but they couldn't because they didn't swap out to tenants in common 2 years ago. So like I said, I don't mind consulting because it can be pretty nuanced, and I want to solve problems and save people a lot of money, and that's what I enjoy doing.
By the way, like, how do you, I mean, what does it mean, like, UPREITs that you mentioned? And also, let's say, if they're preparing, I know, like, I don't know if this is more on, like, a tax advice to, like, because let's say they are trying now to retire, then you mentioned, like, say they want, eventually, the owner wants to split it among his children or whatever. What's the, yeah, how do they do it? Like, let's say DST, then, because you mentioned like the name should be on the 1031 exchange, should be under your name. Then can you restructure it like as a trust, or then there's a beneficiary kind of?
Yeah, it can be your name, and then you restructure it into a trust 2 years down the road. Yeah, or like I said, we were both tenants in common on a small property, and we wanted to put our partnership together. So maybe we drop tenants in common and put ourselves into one LLC that was in taxed as a partnership. So there's still, because there's some tax pass through there, but with a K1, but because what they would call old and cold, it's been years. You can make changes to title. But if you're trying to make changes to title like right away, right after you buy a property, and then you want to put it into this LLC with your friends, that's fraud. And you can blow an exchange that way, or you're trying to do it in the middle of an exchange. Obviously it's not going to fly, but there are ways to change title around, primary residence to not a primary residence, and then vice versa. You can do those things after a period of time. That's another one of those gray areas in the tax code, but completely possible.
Okay. Because I think people at least those who are like in the late stage of their career in investing, they might want to at least start delegating it at some point to their children and even. But the thing is if you're under this exchange and let's say you own it, it's still like the proceeds of the cash flow will still need to be cash to you, right? It cannot be just go directly to your children. It's up to you, like how after you get the money, then split it, I guess, or something.
Talk to an attorney.
Yeah. How do you? I guess it will be like more on the. That's what I'm planning. Maybe I'll try to interview an estate attorney, like in terms of now yours is a good segue of doing 1031, keep on flowing kicking the bucket, then up to some point like now you reach at your retirement age. Now what? What's
Yeah.
what's
Well,
that?
I mean, like,
Yeah.
I know Robert Kiyosaki does, he buys apartment buildings. He leverages out his business to buy large pieces of property that he can get a lot of debt on, make the property better.
Mhm.
He'll, maybe do a cost segregation study on it. So they do the rapid depreciation while, maybe he refied it and took a bunch of money out, but they'll, the whole LLC will do a big exchange into another property.
Yeah. Keep
And Robert Kiyosaki is active, but he's older. Like he doesn't, it's not like he's in there managing the properties every day, and he can do a lot of things with it, but he's got the team, the estate planner, the attorneys, the CPA that are backing him up every part of the way. And I think that's an essential part of your team as an investor, right? So I wear a couple hats, acquisitions, real estate broker, exchange accommodator, investor, so that's how I can kind of put these together with advice, rather than just be like, oh, I'm your qualified intermediary, I'm going to sit here and just push papers around. Like, I like to help people solve problems. And so there's a lot of things that you can do, but I do think that getting the right team behind you is probably the most important part, more than knowing all these things about 1031s, because once you know them, you'll be able to do them. But having the right team to go in with, to handle your estate in retirement, and having that retirement plan, having your CPA right there that you can call and handle things. I mean, all of those are very important. And people, Robert Kiyosaki found his partner in apartment deals, and Ken McElroy, and they just do exchange together, just keep growing the whole thing together.
Yep. That's good. Okay, I think we reach the end of this show. Thanks a lot, Nathan, for your time, and really appreciate all this 1031 information that you shared to us.
I'm sorry that it's probably too much, but yeah, here to help.
It's really good. Yeah.
And hopefully got now you're getting inventive, and you want to do 1031s, and you're thinking of ways you can really grow your portfolio. And hopefully that was what I brought.
Yep. Definitely. Then I will also share in the show notes of this YouTube video the contact for Nathan. So if you have any 1031 exchange that you're even thinking of selling, you can reach out, then Nathan probably can give you some advice how to approach it.